my screen.
Oh, there we are. Perfect. Hold on. We're getting a little back.
Do we need to do anything throughout those presentations? Change slides or switch anything to you or anything? Other than talk?
Can you hear me?
Now we can.
Yeah. Can you hear me?
Yeah. Can you
Say that again.
What's that? Now we can't hear you.
I can't hear you now.
Can you hear me now?
Yes.
Now we can.
Okay, great. You know what? I think I'm going to have to jump off my call. Let me just end this really. Hold on. Go ahead.
Hi, Brooke.
Test?
Yeah.
Test?
Yeah.
Hello, everyone. Thank you for joining our webinar today. I see we have a couple of people on right now. Just to make sure you're hearing me okay, if you could do me a huge favor and raise your hand, that would be great. You should have an option to raise your hand for if you have any questions during the presentation or whatnot. So if you could just test that out for me, maybe a couple of people raise your hands, that would be great. Thank you so much. Oh, perfect. Thank you, everyone. I appreciate it. We'll be starting soon. Hello, everyone. Thank you for joining today's webinar on how the 2017 Tax Cuts and Jobs Act will impact the life science and technology communities. Today's program will be presented by Wyndham team members Shawn Henderson and Tyler Tedesco. Before we begin, I have a few housekeeping notes. Materials for today's presentation can be found in the toolbar located on the right-hand side of your screen. Also at the bottom of the toolbar, you will see a chat box. Feel free to send us your questions during the presentation and we will do our best to address them. If we don't have time to address them, we'll reach out to you after the presentation privately. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. And with that, I'm going to turn it over to Shawn and Tyler.
Thank you, Brooke.
Of course.
Thank you, everyone, for joining us this morning. The purpose and intent of today's webinar is to discuss the tax reform and its relevant areas of interest for the technology and life science sectors. My name is Shawn Henderson. Along with me is Tyler Tedesco. We intend to cover things regarding corporate tax law change, partnership pass-through changes, compensation issues, interest limitations, touch briefly on some international issues. So if you have any questions, again, as Brooke said, send them on over. We're happy to answer that. I'm sure we'll cover that again at the end. And with that, I'm going to let Tyler take over.
Great, thanks, Shawn. Let me change the slide card.
Brooke does.
Great. So of course, we've all heard by now, President Trump signed into action the Tax Cuts and Jobs Act. This was signed in on December 22nd, 2017. And certainly you've seen the impact it's made on the tax industry as a whole. If you watched President Trump's State of the Union the other night, he did make quite a few remarks about the impact thus far and where he thinks we'll see the tax picture going forward. The important thing to note, and what we want to make sure we really stress to everyone here, is that unless otherwise noted, the changes are effective January 1st, 2018. And when we say January 1st, 2018, we can't confuse this. Tax compliance season is coming up very shortly. You'll soon be receiving information request list. All of this information and compliance that you'll be discussing shortly with your tax preparers is in regards to the 2017 tax year. So a lot of these tax concepts and a lot of this information we discussed today will not be relevant in the near-term tax filing, but really the latter term that's filed in April of 2019. Okay, and of course, this is all a federal change. All the changes we're going to discuss here today are federal tax changes. We do expect some additional complications and complexities at the state level. To date, there has been limited guidance at the state level, but of course, updates will continue and we'll continue to keep you informed as developments come about. So what are the major changes? First and foremost, one of the major changes is the corporate rate change, right? So historically, we've always had a 34 or 35% C corporate tax rate. That tax rate has been cut down to a flat 21% tax rate effective 1/1/2018. If you are a fiscal year corporation filer, maybe your year end doesn't quite coincide with December 31st, and you have maybe a 6/30 year end or a 4/30 year end or something of the sort. For your 2018 tax filing, fiscal year ended, whatever in 2018, you will have what we were referring to as a blended rate. And this comes about because part of your year will have been while the tax rate was at a 34 or 35% tax rate, and part of it will be after the tax law is enacted and you're at 21% tax rate. So to keep parity in the tax law, what was decided was there would be a blended tax rate. You may end up somewhere between 21 and 35, perhaps 24 or 25 or 27 or so on and so forth. It's important to keep in mind. One of the major impacts that we think certainly will affect technology and technology startup emerging growth and life sciences are the new rules relating to net operating loss deductions. So certainly we're all familiar with the old laws as they stand. If you incur operating losses in your business, you can carry these losses forward and offset future income. Okay, tax reform that's effective for net operating losses incurred on or after January 1st, 2018, we'll see new law. First and foremost being that these losses are limited to 80% of taxable income. And why this is important is if you become a tax or an income producing entity in tax years 2018 going forward, and you only have net operating losses from 2018 going forward, you will be subject to an income tax of some sort. The government will no longer allow you to fully eradicate and reduce your tax bill to zero. All net operating losses generated in 2018 going forward will now carry an indefinite life carry forward, meaning they will not expire. And there will no longer be a carryback provision. And just for some comparison, the way the current law stands and net operating losses generated before 2018, there was a carryback period of 2 years. So if you had prior taxable income and current losses, we could always carry those back to recoup your tax bill. There was a carry forward period of 20 years, and they may reduce up to 100% of taxable income. And the important part to consider here is that your net operating losses, certainly to the extent you operated, prior to a 2018 tax year, they will be bifurcated. Okay, and any operating losses you incurred before the 2018 tax year are still subject to the old laws. They're still allowed to carry back 2 years, forward 20 years, and reduce up to 100% of taxable income. And any losses incurred after 18 are subject to the new laws of 80% and indefinite carry forward. So to the extent you foresee taxable income in the near future, you can still upset, or you need to consider the bifurcation, the carryback rules for your net operating losses incurred both before and after 18. The alternative minimum tax at the corporate tax level has been repealed. And with that, any alternative minimum tax credit carry forwards are becoming refundable. And the refund is going to be a phase-in refund. Up to 50% of the remaining credit is refundable per year in January 1, per year in 2018, 2019, 21, 22. If you still have remaining AMT credit carry forwards after 2022, the entire amount will become refundable without any limitation on that. Also, the DPAD, the domestic production activity deduction, has been repealed and is no longer available to any taxpayers. Tax accounting income deferral, which I see quite commonly, especially in the technology and the life sciences industry, has been codified. And what this means is it's a very important code section and a very important regulation for people in our industry, because it helps to allow our companies in our industry to defer income on deferred revenue contracts. Okay, so quite commonly you have a deferred revenue contract in which you'll perform services over a length of, say, 12 months or so. Generally, as you collect the cash, it becomes taxable. However, because of our accrual basis income deferral regulations, and especially this new codified code section, you can defer that income if your contracts are no longer than 12 months. And this is particularly useful if you sign into a deferred revenue contract on the latter half of the year and have a cash pickup up front. The contract is fully paid for. As long as that contract is not going to span more than the length of 12 months, you can match your book and tax concept. So there will be no taxable income until you recognize it for book purposes as well. No accelerated taxable income. And with that,
okay, we're going to be moving on to polling question number 1. And as a reminder, everyone has to answer these questions in order to receive CPE credit. So, what is the new C corporation tax rate? A, 20%, B, 21%, C, 25%, or D, 32%? You have about 45 seconds left to answer the question. "20 seconds left, so make sure that you're getting your answers in. As I said before, in order to get CPE credit, you have to be answering these questions." Okay, and your 1 minute is up. So the answers. Shawn and Tyler, is B correct?
B is correct. The majority of you got it correct. The 3%, we'll find out who you are and send over some additional information. Go ahead.
Okay.
Great, thanks guys. So continuing on, one concept that we feel is very important to our industry as a whole are these compensation changes, especially in the arena of stock compensation and equity compensation. And to caveat this slide before we begin here, these comp changes, it's actually, we'll cover on the next slide, are not available to all taxpayers, right? There are certain regulations, there are certain qualifications in order to allow you to make these elections, okay? And the most important election that we have seen in the equity compensation arena is this 83I election. And what this election does is it allows any recipient of a non-qualified stock option or a restricted stock unit to defer the tax paid on that stock unit for up to 5 years. Generally, the way you are taxed when you receive a non-qualified stock option or restricted stock unit, when that stock option vests and you are entitled to exercising the option, the government deems taxable income to you. And this in the past has caused a hardship on a lot of recipients of these options because they're issued through private companies. And what that means is, although the government's saying you have a taxable income, you have taxable income because you've been given something with a market value, and you are deemed to have to pay tax on that market value, you don't have the cash to cover the resulting tax liability. And the government has recognized this. And by putting this Section 83I in place, the hope is that you are receiving this market value, but you can defer tax for up to 5 years. If your company goes public beforehand, or if you cease to be an employee beforehand, the tax is due earlier. But their hope is to allow the recipients of the equity compensation to monetize the compensation before they have a resulting tax bill without any cash in hand to pay it. The income is determined on the earlier of the date the stock is transferable or it's no longer substantial risk of forfeiture. And one thing to note is that payroll taxes are still due on the earlier vesting or transferability. So when we say that there is an income tax deferral, that is only on the income tax side. It does not defer payroll taxes. And who can make these elections? Qualified employees can make the elections, and what the code section does is it defines a qualified employee by telling us who is not a qualified employee. So for purposes of this code section, if you are a 1% owner of the company, if you are the current or former CEO, if you are related to any one of the above, or if you are one of the 4 highest paid compensated employees, you cannot make this election. Further, only an eligible corporation can issue stock that you can make this election for. And eligible corporations, meaning that the stock is not publicly traded when issued, and the corporation has a written plan under which at least 80% of the employees are granted stock options. Also very importantly, that I don't see on the slide here, is if you have made a valid 83B election, you cannot make a valid 83I election, right? It's one or the other. The next topic we like to just quickly touch upon is the business interest limitation. For tax years after 2017, again, starting in January 18 going forward, net interest expense is only deductible to the extent of 30% of what we're calling adjusted taxable income. And this may not result to every company in our space of life sciences and technology currently, but it will certainly result to highly leveraged companies. Anyone who's holding a lot of debt with resulting interest expense may want to keep their eyes on this new tax reform regulation. Luckily, it does not apply to businesses with average receipts of less than $25 million. So if you are in the startup industry and you've just taken in some sort of convertible debt or something of that sort, maybe you're pre-revenue, this will not impact you until you've grown your business to have average receipts of over $25 million. If you are a flow-through entity, the limitation is applied first at the entity level. So you don't have to worry about your K1 giving, passing through some sort of expense that you'd have to reconsider, this will all be taken care of at the flow-through level. And lastly, any excess interest expense, so any interest expense that is non-allowable because it is over 30% of our adjusted taxable income number, will be carried forward indefinitely until the company can deduct it. Very importantly here, it may not apply to our industry as a whole, but if you are in the industry of a real property trade or business, you can make an election to not have this business interest limitation apply to you. The setback of the election is that you must use the ADS, the alternative depreciation system, otherwise known as generally straight line depreciation on all of your assets, and you may not elect bonus depreciation. So one of the tax planning concepts and what needs to be considered here is will your asset purchases and additions of your fixed assets outweigh your business interest deductions? And certainly if you're going to invest in your company and purchase a large quantity of fixed assets, you may not want to make this election because you'll lose the option to accelerate depreciation deductions. And one last thought on this, just to define adjusted taxable income. Adjusted taxable income is taxable income before considering income gain loss not properly allocable, before considering your interest expense for the year, your net operating losses, and very importantly, before considering depreciation, amortization, or depletion. So this is very similar to earnings before interest and taxes, EBITDA. There have been a few updates and reforms to our elections regarding our fixed asset additions and depreciation. One of which is the Section 179 expensing that you may be familiar with has been revised. They have increased the amount the taxpayer may expense under Section 179 to $1 million, formerly $500,000. The Act has also increased the phase-out threshold to $2.5 million. Which is formerly $2 million. And when we say phase-out threshold, this Section 179 expense election is phased out dollar for dollar. So meaning the benefit is reduced if you add an aggregate of over $2.5 million of equipment in any given tax year. Also, the Act expands the definition of qualified real property to include qualified improvement property and certain improvements. And this is just another way of saying if you are a qualified lessee, any additions or adjustments to the inside of the property or the inside of the property, the roof, the ventilation, the air conditioners, etc., may qualify for a Section 179 tax deduction now.
One more note on the Section 179 is generally 179 is limited to your business income. So you must have business income to take advantage of Section 179 in a current year. And as Tyler mentioned, if you put in place eligible assets that are eligible for Section 179 treatment, if that exceeds $2.5 million in the future, if say you put in $2.6 million, it will be a dollar for dollar reduction of the eligible 179 expense of $1 million by $100,000. So a dollar for dollar reduction of that million. So assuming you have business income of more than $900,000, you'll be allowed and limited to $900,000, not the $1 million. So that's what that threshold of phase out represents.
Okay, and we're going to be moving on to polling question number 2. We're having a little technical difficulties, so we're going to skip this one and we're going to come back to it. Okay, guys?
Okay.
Okay.
All right. So I want to go ahead. We're about at the we're about 40% into the presentation right now. I wanted to go ahead and just point out that everything that we're presenting today is as how we know it today, and there's still a lot of clarity and guidance that still needs to be issued from the IRS. It was done rather quickly, and and we're all scrambling, keeping on top of it. But this is as of it is presented, and any time that there is an update, we'll be sure to push it out to you. But now, after 179, we're going to jump into bonus depreciation. Bonus depreciation is defined by Code Section 168K, and historically it has fluctuated from year to year. Some years it was 100, some years it was 50. So pre-law, pre this tax change, it was 50% for the last few years. Leading up to the new year, and this is one of the changes that is in effect for your 2017 income tax return that's due in the next few months. So the date that you need to remember is September 27th, 2017. And so what it allows is eligible expenses, and this is not tied, unlike 179, this is not tied to business income. Bonus depreciation may be taken regardless of business income, as long as they're eligible assets, and we'll get into the eligible assets in just a second. But you are allowed to take a full expense of 100% of the full value of the asset in a given year for any property acquired and or placed into service after September 27, 2017. So this goes forward for the next few years, ending in the year 2022. After that, there will be a 20% phase out over a 4-year period, and with the end result in 2027, unless further change occurs, of no longer having bonus depreciation. And what you need to do is, and what we need to consider is, with the eligible 179 and the increased thresholds, the eligible bonus depreciation of 100%, we have to consider, there's a lot of planning opportunity, a lot of planning, depending on the amount of assets you put in place, and if there's going to be any phase out thresholds. With the 179, we need to consider bonus depreciation for that. And so for the actual 2017 income tax year, 179 was in play for majority of the year. Granted, there were slightly reduced amounts that were available for 179, but with the addition of the September 27th date, we may have some ability to take further deductions than originally anticipated with the mid-year split. So we need to keep that in mind for planning purposes. Additionally, as Tyler's mentioned in a few of the other slides, with reform comes a little complexity. So there's still some guidance. There's still states scrambling around, because under the 2015 PATH Act, there were plenty of states that didn't conform to bonus depreciation. Additionally, there's under the 2015 PATH Act, there were a lot of states that didn't conform in its entirety to 179. So there can be some issues regarding state unless further guidance is provided from the state. So even though we're taking 100% deduction for federal purposes, we may have a little bit of an add back for the states. So we just need to consider some of the state implications in doing some of these things. So we'll go on to the next slide, talk about the eligible assets. So the eligible assets are any assets that generally have a depreciable life of less than 20 years. This is going to be your computer equipment, your tangible, any of your tangible property, your furniture, certain things like that. I mean, specifically, certain real estate or real property is excluded a little. There are some that are allowed, but there are some that are excluded. Computer software, the reference to computer software here is computer software that is treated under 167 and depreciated as such, that's eligible for 179 as well. This doesn't include your self-created computer software, which we'll discuss later, which can be treated as separately as research expenditures. Additionally, qualified improvement property, if it has a 15-year life, it's automatically covered. This can be interior improvements to your building, and certain other factors of real property. And then additionally, for the film and television guys, they throw in some of the production into the life and are eligible for the bonus depreciation. So it's not allowed, as Tyler mentioned, the ADS is an alternative method. It's straight line. There's no accelerated depreciation for elected ADS property. So if we've made that election, whether it's for the business interest limitation, the bonus is not going to be eligible to be used. And the last and final bit of it, pre-2018, the law was that all the assets eligible for bonus had to be brand new first to the client. It had to be brand new. Now it just must be the first use by the taxpayer. So it can be used property, but as long as it's the first use by the taxpayer, it is eligible for bonus depreciation. It no longer has to be quote unquote off the shelf and brand new. So do we have that polling question or no?
No, we're actually going to skip that one, but we have the other two, so we'll be good. You guys are still eligible for CPE.
Okay. All right. Thank you, Brooke. All right. So the next thing we want to talk about is meals and entertainment. Well, entertainment as described, membership dues, entertainment, hockey tickets, baseball tickets, anything that's deemed entertainment in that fashion previously was deducted at a 50% rate along with your meals. That is no longer the case. They have completely wiped out the deduction for entertainment expenses for pleasure, recreation, social purposes. They've gotten rid of that expenditure in its entirety. Additionally, for the meals portion, that was also 50%. That's been retained. So meals provided to food and beverages expenses associated with the business are still going to be retained at 50%. So the entertainment went away, meals are retained at 50%. However, there is a slight change to the meals that are provided to the employees or the convenience of the employer. So if they're on site and they're continuing to work and you provide meals to them, those are no longer going to be 100% tax or 100% deductible. Those are going to be limited to 50% and qualified as a de minimis fringe benefit. So you're still not going to have an inclusion in any employee's W-2 or compensation. However, from a business perspective, you no longer get the 100% deductions. It's now going to be limited to 50.
And one note to make, just as Shawn kind of discusses the rules there, one suggestion we are making to clients and bookkeepers or controllers out there are that a lot of times, or most times, you have an M&E account, a meals entertainment account. We are suggesting that you bifurcate those accounts, one for meals and one for entertainment, just because of the new regulations. And you do need substantiation should the IRS ever ask any questions. It's just cleaner record keeping. And it will allow us an easier job and you guys to track them easier as well.
Yeah, excellent point. One last thing on this, for years after 12/31/2025, under current legislation, the deduction of 50% is going to go away in its entirety. So in a few short years, unless anything changes, it's going to go away in its entirety. The next slide relates to tax accounting changes, cash method, and 263A and the treatment of inventory. So under prior law, we'll cover first the cash method. If you were a partnership that had no C Corp partner, you were an S Corp, an individual personal service corporation, you didn't have any issues with staying on the cash method of accounting. However, if you were a C Corp or a partnership with a C Corp as a shareholder, there was what they call a small business taxpayer limitation, which was an average gross receipts of $5 million. So if you exceeded that amount, you were required to file your income tax return on an accrual basis. Now, what's happened now is the IRS has increased that amount to $25 million. So for any of the entities that were stuck in the middle, the $10 million range or any of that level, it's now been bumped up to $25 million. All related guidance is still in play. So personal service corps, partnerships without a C Corp, pass-through entities, those guys are still not required to conform. There's been no issue or change there. They are still allowed to use the cash method. The only change really is to the C Corps, the partnerships, and these are the guys without inventory, because we'll cover inventory on the next bullet point. But that threshold, that three year average threshold, has been increased to $25 million from $5 million. And the $25 million is in play regardless if you're purchasing, producing, or selling or reselling items. So the second method or second accounting method change was inventory accounting. So as previously discussed, right above, we were talking about the $5 million threshold. Well, there was this threshold for certain entities that had inventory. If their gross receipts were $1 million or less on a 3-year running average, they could maintain a cash basis taxpayer. However, if it went over that threshold and they had inventory, they were required to start using generally speaking, they were required to start using the accrual basis of the tax, What now has occurred is they bumped that up in its entirety, kind of give the matching principle to all the related accounting method changes on this slide, and they bumped that up to 25 million as well. And so if you have inventory, you're not over the $25 million 3-year threshold. What you have to do, the way you treat your inventory is you don't have to capitalize it under what they call Section 471, the purchases and the direct cost. You would treat them either as incidental materials and supplies, or you would have it conform to what your accounting method is and what you file for your financial statement, something that closely resembles your business model. So again, that threshold of 1 million for those entities with inventory has been bumped up to 25 million. Now, the last piece is UNICAP. It's, the code section that commonly here is 263A. Generally what this is, it's the indirect cost associated with the production or resale of tangible personal property. And what that means is you go through activities and business ongoing operations, and while you have the direct costs, those are easy to classify. There's overhead, there's general and administrative costs, and other related items that can be tied to the production. So in essence, they want to capture what has been deemed to still be retained in ending inventory at the end of the year, what's been sold. So it's a more reflection of the actual cost of production. It's a matching of the revenue and expenses to a sense. So under previous law, resellers had a $10 million threshold. And if they didn't have that threshold of $10 million, they didn't have to do UNICAP. But as soon as they crossed that threshold, there was a requirement to start picking up 263A. And without going into the detailed calculation, it is more or less you're capturing the indirect costs associated with the inventory based on what they call an absorption rate. So it's really the ending inventory portion on a pro rata basis of what's been sold. So that was previously 10 million for a reseller. For a producer, unless they met one of the three exceptions, which are rarely seen, one of which being indirect costs for less than $200,000, they were required to do UNICAP at any level. But based on the reading of what we have, is the small business exception now for 263A no longer applies to resellers or producers if they meet the $25 million gross receipts test. So all these three items kind of work interchangeably together, cash and accrual, and they all kind of have the same, which is from a matching principle, they had to make them 25 million. So that's kind of the brief overview of the significant tax changes, accounting method changes related to our industry. So the next couple things we'll talk about are the drug credit, the orphan drug credit, the medical excise tax, and the R&D. So at the R&D historically has been allowed to be, if consistently applied, was allowed to either be deducted in the current year or capitalized, amortized over a period of no longer than 60 months. That was the old way of thinking. And these are what we call specified research and experimental expenditures. And they relate generally to the development, let's say an example is self-created software. And so those expenditures now going forward, for any expenditures incurred after 2021, are now required to be capitalized and amortized over a 5-year period. With the exception, if the production is done outside of the United States, it's a 15-year amortization period. Additionally, if there's any retired or abandonment or disposal of any software throughout that period, instead of taking a current year write-off for the remaining basis, it must continue to be amortized for the life of that asset and from the date it was put in place. Now, the specified research and experimental expenses related to this R&D credit include the software development, the wages and all the other items that are generally included. They do not include the land or tangible personal property related to the production. So the tangible personal property is going to go on as an asset in itself, and it won't be included in this new capitalization 5-year, and will still be eligible for 179 and some of the bonus stuff. So that's the real big change with R&D. A second is the orphan drug credit. Generally, the orphan drug credit is to qualify for the orphan drug credit, it's generally must have occurrences of less than 200,000 people in a given community in the United States. And it used to be based on the specified expenditures related to the orphan drug credit, and it was a credit of up to 50% of those expenses allowed to be deducted for your tax purposes. Well, when that occurs, generally those also qualify for R&D. So while both may qualify for R&D or for the orphan drug credit, you are not allowed to use the same expenditures for both credits. So law and planning is needed to do the orphan drug and the R&D credit. But the new law and the change in it is that instead of it being a 50% deduction going forward, it's now limited to 25% of those credits or of those expenses that are incurred for the orphan drug. Or you can make what they call a 280C, a similar 280C reduced credit, because under the previous with the 25%, you must reduce your expenditures by the amount of the credit you receive. However, if you take a reduced credit, you can take a reduced credit less than the 25%, maintain your expenditures, and try to maximize that. So calculation needs to be done and see where your orphan drug lies. And just so you know, the orphan drug is available once the FDA deems it to be an orphan drug. The expenditures from that date to the date the FDA approves it, all those expenditures can be qualified as related expenses for the orphan drug credit. The last one is the medical excise tax. And when we originally set out to do this webinar, there was prior guidance, and the medical excise tax was back in play effective 1/1/2018, but since there's been a moratorium put in place until 2020. And what the medical excise tax is, it was put in place a few years ago in 12/13, and it's a 2.3 medical excise tax on qualified medical devices that are by the manufacturer producer that has to collect and remit the medical excise tax. It was in play for 2 years, and then effective 1/1/15, all medical excise devices, the excess tax was wiped out and put on hold for a 2-year period, set to go back in place on 1/1/18. And for a period of about 18 to 20 days, medical excise tax should have been collected, and the IRS has provided guidance since then that anything remitted or collected needs to be returned, and if the IRS has the funds on file, they will remit the funds. But as of right now, it's a highly disregarded. It's not a well-liked tax. So it's been put out of play until at least January 1, 2020. And with the way legislation is going, I wouldn't be surprised if it's out in its entirety by then. So the next set of changes is Tyler hinted at the beginning. We had all the C Corp changes. The next couple of slides are related to what the pass-through changes. These are going to be your partnerships, your S corporations, and how they impact the individual income tax return and their changes. And we might get into a little bit of a discussion on methodology behind it and why this is all in play. So what it provides is a 20% deduction for your allocable share of qualified business income. And that's capped by your allocable share, either 50% of your allocable share of W-2 wages or 25% of the individual's allocable share of W-2 wages plus 2.5% of the unadjusted basis of the property. So what that means is if you have qualified business income of $100,000, there's going to be an eligible deduction of 20, assuming that your allocable share of W-2 wages exceeds the $20,000. The second piece, you may ask, why is that in play? There are certain partnerships that don't pay any W-2 wages. So if we had the first restriction in itself, we would be limited to no deduction whatsoever. So the second one's in place simply to provide the 2.5 of unadjusted basis in your business property. So any of your fixed assets in play, up to the 2.5% of that will be your threshold in determining what your QBI deduction is. The QBI deduction is not limited to a single taxpayer less than $157,500 of AGI on their personal return and $315,000 if they're married. So it's allowed in its entirety without referencing the deductions up above. And what this does is, we're not really going to get into some of the individual income tax changes, but the individual income tax, the maximum rate is now 37% as opposed to 39.6. And with the reduction of 20% reduction of that 37% brings your effective top rate down on pass-throughs to 29.6. And you may wonder why that's important. Historically, pre-law, pre-tax changes, a corporation was paying tax at a 34 to 35%. And additionally, the shareholders, upon receiving dividends, had to pay tax at a dividend rate of 20 to 23.8%. With that said, that's about a 43% swing. Dropping the corporate rate down to 21% creates a significant gap, and it really didn't. Then it started making, then you had to start wondering, was it really worth being a pass-through entity and the favorable treatment? So this is sort of a kind of a hedge to kind of bring that gap a little further apart. And that's why there's the 20% reduction. The deduction, go to the next slide. The deduction is available to shareholders of an S corporation, partners in a partnership. It's available to sole proprietors reporting on Schedule C. It's also for rental property. And when you get into rental property, it's not to this audience group, but that's one of the entities you don't see a whole lot of wages unless it's a management company. So that 2.5% addition there of the unadjusted basis is going to provide the extra 20%. So what is qualified business income? It's essentially the ordinary income derived from the business itself, from the sole proprietorship, the rental property, the S corporation. It doesn't include any of the passive income, the capital gains, the interest income, the dividend income. So it's essentially your ordinary income derived from the business activity. The next slide gives a general description of the qualified business. Long story short, it's a trade window business that is not a service business. And service business is still being defined, is still changing. It specifically states under 1202 that it's in the fields of health, law, engineering, architecture, but then some of it's been removed. And so guidance on what qualifies and what doesn't qualify on what's a service industry is still coming. The IRS is going to issue additional guidance on what's qualified as a service industry.
Okay, polling question number 3. Which of the following measures can be used a limitation of the 20% pass-through deduction? A, 50% of your allocable share of Form W-2 wages. B, 25% of your allocable share of Form W-2 wages plus 2.5% of the unadjusted basis of your fixed assets. C, both A and B, or D, none of the above. So just so you guys are aware, you do have to complete the polling question, but it's okay if you do not get the answer right. You will still get CPE credit. It's totally fine. So you will have about 20 seconds left to answer, so make sure that you're getting those answers in. And about 5 seconds left. I see some of you are still voting, so make sure to get those last votes in. We're going to close it right now. Oh, some of you are still answering, so I don't want to shut it out yet. Okay. So our answer was C, both A and B. So good job. Majority of you got it right.
Yeah, I think there's a little bit of I'm seeing a little bit of a different question. Just to clarify, everyone, it is 25% of your allocable W-2 wages plus 2.5% of your unadjusted basis, or 50% of your allocable W-2 wages. The one that I saw was a little bit different. If B and C were both correct, and the one that I saw, I don't know who else saw that one. All right, so as mentioned before, there's a little bit of talk with the reduced corporate tax rate, depending on where your interests lie and what your ongoing operations and your future holds, whether you should convert from a pass-through entity or an S corporation to a C corporation, and that's really yet to be determined. It depends on your circumstances where you intend to carry the business. But if you do elect to revoke an S election, in doing so, here are some of the guidance they provided if you revoke the S election and go into a C corporation. So in the first year that you've revoked your S election, any distributions as a C corporation, so to the individual shareholders after you've converted to a C corporation, they will not be taxed to the extent they have AAA. AAA it's a convoluted calculation, but it's more or less the retained earnings, essentially less than distribution, some other actions that happen in there. But it's essentially your earnings from the S corporation itself. So if you're distributing from that account, they're going to be tax-free, obviously to the extent of stock basis. Then you get into some different. After that, from the second year after revocation, you will then have to prorate the distributions received or the dividends received between the corporation's E&P, earnings and profit, and the previous AAA account. So there's going to be some taxability in the dividend and some return of the AAA account. And so if there is a requirement to change accounting methods because you converted from a C corporation, and let's say you're over the 25,000, so you had to convert to the accrual method of accounting, then instead of taking the normal 4-year inclusion of income, they're going to allow you to take that in a 6-year period going forward as a 481A adjustment. In addition, to take advantage of all these S corps, you have these S corp rules and guidance when you revoke it. You have to maintain the same ownership, or the same shareholders must own the former S corporation in the same percentages for 2 years after the revocation. All right, so a lot of this reform has to do with international tax compliance, and we're going to cover at a high level a lot of the international changes and try to bring it home and try to make it one big picture. And if you have any questions, we're happy to answer the international questions. But the first thing that is covered in our section is the foreign source dividends. So what this relates to, and this is, we're going from, the United States is going from what they call a worldwide tax. Just under previous law, worldwide method of tax is we're going to bring all the income back here. Eventually, when it's distributed from our foreign corporations, it's going to be taxed as a dividend to our individual shareholders or corporate shareholders. What we want to do in our intention is to get over to a territorial tax system. So we're going to essentially try to align the income and the taxation of that income with the countries where the income's earned. So this is the first step of that process. And so on an ongoing basis, if you're a 10% or more shareholder of a foreign corporation, regardless if you're a corporate shareholder or an individual shareholder, we're going to allow the corporate shareholder is going to be allowed a dividend received deduction of 100%, which essentially says we pick up the dividend, we back it off as 100% dividend received deduction, and it flows through, and there's essentially no tax change to the corporation. For individuals owning, there's a little bit of a calculation that needs to be done, and we'll talk about that in a minute with the E&P stuff. But essentially, we're trying to get the lockout effect and not remitting funds back to the United States. We're trying to get that out of the equation and have it taxed in the location that it's at. The only issue and the only requirement is that we must maintain, or we must hold the stock on the dividend for a year, or we must, if we receive it in the first year, we must hold it longer than the year to get the 100% dividend reduction. So additionally, there's not going to be an allowance. Previously, there was a deemed paid credit allowed on certain distributions of income, subpar F, some of that stuff. But there's no longer going to be on dividends received to the United States that's eligible for the 100% dividend received deduction is no longer going to be eligible for any foreign tax credit. So there's not going to be any foreign tax credit. The only thing that's not eligible for it is a hybrid dividend. Generally, you don't see a lot. We won't see a lot of those in this industry. But that's the majority change regarding the territorial tax system. The second part, so we have this concept, we're switching from worldwide to a territorial tax system. But what do we do about all the previous earnings? Well, this is one of the things that come into play. So we have to look at, and this is effect for 2017. So this will go on your provisions. This will be impacted on your income tax return. These things are in play for December 2017. And what this states is, all right, so now we're going to a territorial tax system. But previous to that, we were worldwide. But they haven't remitted all the funds. We've been locked out since then. So how do we get all the funds back to the United States? We're going to do what we call a mandatory or a deemed repatriation. And so what that essentially is all the pre-1986 or the post-1986 accumulated earnings and profit from the generation, and 86 is basically the last reform. So we're going to look at the last 30 years of retained earnings or accumulated foreign earnings and profit, and we're going to take a look at that and determine if there's a positive E&P. Then we must look at our assets held at the greater of November 2nd, 2017 or December 31, 2017. And this is in effect for even non-calendar years, so fiscal years that have this, that has the last tax year beginning before 2018. This is when this is going to be eligible. So what it is any cash or liquid assets will be subject to a tax of 15.5%, and any non-liquid assets would be subject to an 8% tax. And this is to the extent of E&P. So if you have negative E&P, there's not generally going to be a tax. But they're trying to catch up and make sure that we have everything repatriated to date. So that's the first step in getting it determined. Then we're going to switch to the territorial, and then things are going to be taxed in its normal state. Now, once you determine that, the liability is due on April 15th, and if elected, they can pay the liability over an 8-year period, which years 1 through 5 will be at an 8% rate, and then 15, 20, and 25% for years 6, 7, and 8. So there are special rules for S corps related to this, and you can defer some of this depending on your S corp status. But again, this is related to a shareholder of, and this includes individuals, a shareholder of a foreign corporation that has post-86 foreign accumulated earnings. The high level foreign tax credit changes that have occurred. Prior, we were allowed a deemed credit for subpart F income, which had to be included for certain shareholders for certain types of income earned. We were allowed a deemed credit. That's no longer allowed for that income. Additionally, the act prior to the tax law change, any income, if the U.S. industry or the U.S. business had a net operating loss, yet we had foreign sourced income, and we weren't allowed to take the credit because we didn't have any income in the United States. Subsequent years, we were allowed to take a deduction either to 100% or 50% of the current year net income from the U.S. perspective, and we were allowed to call that foreign source to kind of get that credit back. What's happened now is there's an election provided to increase that amount to a percentage no higher than 100%. So there's just a change there. Pre 2018, for the foreign tax credit purposes only, we used to, if you were a U.S. manufacturer producing and you were selling to foreign countries, that production of those sales were allowed up to 50% were allowed to be considered foreign sales for the purpose of foreign tax credit. That is no longer, we are now going to look at for purposes of that from production standpoint. And so where it's produced is going to provide what's foreign sourced. And then additionally, prior to, we used to have only 2 buckets, a passive and a general bucket for foreign tax credits. Now they're going to include a bucket for in itself for the foreign branch income. So the next slide. So this is a little bit of an exporting. This is where your intangible income is coming into play. And without going into the nuances of the calculation, because it's a very complicated and convoluted calculation. Essentially, this is a little bit of a beneficial treatment for those U.S. corporations that holds and maintains intangible assets, or derives income from intangible assets held in the United States that are sold or used by entities in a foreign country. So from our perspective, let's put it an example of IP held in the United States and used, by foreign countries. What we've allowed is, depending on the calculation, it's in excess of your 10% of what they call your qualified business asset investment. Essentially, that means, all your machinery and equipment that's used to generate qualified business income. If your intangible income exceeds this threshold, and we won't walk through the entire calculation, there is going to be an amount that's going to be subject to this tax. But for an incentive purpose, the IRS has reduced the tax rate for this sourced income to a 13.1 as opposed to the 21. So there's a little bit of a benefit to maintain and keep the IP in the United States and put it out of the country with tax rates. This is the other half of that equation. So if you looked at that was an incentive, this is kind of a detriment a little. This is what we refer to as the global, or the GILTI income, global intangible low tax income. This is for the entities in a foreign sub that maintains intangible income. So it's maintaining the IP in a foreign country used by the United States and or other countries. So after walking through the entire calculation, and again, it uses 10% of qualified business. It's a long calculation, but once you determine how much of that income is attributable to an intangible, it's going to be subject to tax similar to subpart F income. So if we go back to the first couple of international slides, we were aware that we're going to a territorial tax system. So why would it make sense that we're having global intangible? This is kind of the, hey, you have it overseas, even though we're territorial, this is required to be reported here. So it's kind of the detriment to moving it off sea. So if you have intangibles in a foreign country used by the United States, it's not protected, more or less, based on some calculations, by that territorial tax system. And I won't walk through the rest of the slide, but that's essentially what that is. Very briefly, I'm going to touch on base erosion anti-abuse tax. Essentially, base erosion is shifting of expenses to low tax jurisdictions to try to bring down the global tax rate, try to bring down the U.S. tax rate, force tax to another country, and based on treaties, there may be very little withholding or no withholding whatsoever. So there's essentially no tax, and obviously we have to have transfer pricing studies in play. But assuming that they fall within the interquartile range, we still have some base erosion. What this is meant to do is this is more or less a minimum tax for those taxpayers having more than 500 million of related party transactions in a 3-year window on average. So that's just kind of a minimum tax that I won't walk through the calculation. But if you're shifting expenses over and you meet that threshold, we may be subject to that. Some of the other miscellaneous changes related to the foreign income is moving intangible transfers. Now we're going to have kind of a valuation change. The next slide, please. We're going to have intangible transfers valuation change. Oh, I'm sorry. We want to do polling question 4?
Yeah, if that's okay.
Yeah, go ahead.
Okay. We're launching polling question number 4. Okay. What type of tax system is the international landscape becoming under this reform? A, worldwide, B, flat, C, proportional, or D, territorial? And you have 45 seconds to answer. And as I stated before, it's okay if you don't get the answer right. We can't see who's answering what question and what your answer is. So it's all miscellaneous, but we do need to know for CPA credit who does answer them and who does not. So you have about 15 seconds left to answer. There's still some people who need to vote, so make sure you get those votes in if you're trying to get the CPE credit. Okay, and if you haven't voted, this is your last chance because we're going to be closing it out. So make sure you throw your vote into the bucket. But okay, so our answer is D. If you put D, you were correct. So territorial.
Correct. That is correct. We were worldwide. We are now going territorial. I have one more slide, and the handouts have the very last set of pages. You'll see have some individual and some other corporate and some overall changes that'll be applicable, and you can read at your leisure. One more slide on international before we wrap it up is intellectual or intangible transfer. Generally, it was done at a related party. Now it's being moved to evaluation. That's what the 367 is going to do. It may require some evaluation to get them over. CFCs pre was, if it was 50% or more owned by a U.S. individual, and at least those individuals own 10% or more, it was considered a CFC, and you had some income pickup. That's been expanded to include attribution. So if you're a U.S. individual holding a foreign corporation or holding a foreign entity that holds the CFC, we're going to attribute it down to you, and we're going to get a better view. And there should be, based on structure, and there should be a lot more included in that. So reconsider some of the structuring if you're operating in foreign industries. The last thing is for subpart F. Previously, there had to be a control for an uninterrupted 30-day period for subpart F to apply to your company. They've gotten rid of the 30-day requirement for it to be considered a CFC for subpart F income. So the next, go ahead.
You want me to go?
Next slide.
Yeah, next slide.
The next slides, guys. First, we want to say thanks for sticking with us with the hour presentation. The next slides are really more for your reading at your leisure. Won't cover all the bullet points here. Feel free to go through. If there are any questions or anything from the webinar was unclear, feel free to reach out to Shawn, myself, or anyone here at Witham. We're always happy to answer any questions.
Okay, so thank you again for attending our webinar. If you have any questions, like Shawn and Tyler said, please feel free to reach out to me. You should have my email address that came with your webinar confirmation. My email address is bmorgan@witham.com, or you can send anyone at Witham a question and we'll be able to point you in Shawn and Tyler's direction. So thank you again, everyone, and your CPE credits will become your certification. Your certifications will be coming within the next couple of weeks, so keep an eye out for those. And if you don't seem to find it within the next month or so, if it doesn't come to you, again, you can reach out to me and we'll make sure it gets all squared away. So thank you, everyone, and have a wonderful weekend. Bye-bye.